Good morning, everyone. Welcome to the macro snapshot. We are just putting the volume up. We are Tuesday, September the 23rd, 2025, recording this morning just after 7 o'clock. Okay, so I think what was interesting yesterday, just doing a quick review, we got quite a few Fed speakers. So, of course, everyone's trying to understand what is the situation on the FOMC. There seems to be quite a huge dispersion between some of the more hawkish members of the Fed. And obviously, on the extreme, you have someone like Stephen Miran, who was appointed by Trump recently, who's a mega dove and arguing for five cuts. So yesterday, there was no surprise that Miran came out and argued quite cogently for a very dovish position, essentially saying that the Fed was too restrictive, that the Trump policies on tariffs were not really sort of inflationary in the long term, et cetera, et cetera. So very dovish, and obviously he's pushing for five cuts, about 100, 125 basis points of cuts. On the other hand, yesterday we had three members who are all sort of a little bit more on the, I'd say, neutral to sort of slightly more conservative or hawkish side of the Fed. So we had Muzalem, we had Bostich, and we had Beth Hammack, who all came out, and they were fairly cautious, essentially saying that the Fed is not terribly restrictive, that inflation is definitely still potentially a problem, that inflation is still sticky, and that the employment situation is pretty solid, 4.3, 4.4. It's pretty good. And most of them yesterday, as I said, those other three Fed members were essentially saying that, maybe the one cut was okay. It was like a precautionary cut, maybe another one, but they'd have to look at the data. So very data dependent. And if anything, slightly leaning towards prudence and not really sort of cutting anymore because they're very concerned about inflation. Okay, so today it's going to be interesting because we get some slightly more dovish sort of people speaking. So we have Michelle Bowman, who of course was a Trump appointee, and also Goolsbee, who's been relatively dovish. So we're getting the full spectrum of sort of opinions. And if we actually just look at the market here, you can see that at this point we're still pricing in 23 basis points, so basically 91% chance of a cut in October. The market still believes that's happening. What's happening is that by the end of December we've got 1.7 cuts, 43 basis points, so not 50. And you can see yesterday, just on the back of some of that slightly more, I'm not going to say hawkish, but more prudent, cautious, concerned Fed speak by those three speakers we got yesterday. You can see here, this is the intraday chart, that the pricing for December just ticked up a few basis points more towards the hawkish side. So we were at about 45 basis points of cuts here. You see on the lower right-hand side, about 45 basis points of cuts. And you can see where we stand now is about 42, 42 and a half. So just ticking up a little bit, just sort of, the market saying, okay, let's just wait and see the data. And also probably more importantly, let's see what Jerome Powell says, because as you can see here, we've got more speakers today. We are the 23rd, of course. We have Goolsbee speaking in about an hour and a half or so, Bowman in the morning, Bostich. And then, of course, the big one, we have Powell. So Powell is speaking at lunchtime, 12:35, at an economics sort of presentation. Economics club. And so it's going to be very interesting here to see whether, just what I'll be looking out for is like the balance of risks. Does he still think that employment is sort of now the most important sort of risk which they have to sort of safeguard against? What about the mandates? Are they still equally balanced, or as I say, is employment really tipping the scale? And then the labor market, is that sort of, does he still consider that potentially fragile? Any updates on that? Any updates on his view about inflation? And of course, any hints about, what would cause more cuts? As I say, the market is pricing in now almost two more cuts by the end of the year. So long story short, interesting to hear what Powell has to say today. And that's probably going to give a little bit more of the market direction. If we just look and have a look at some of those short-term bonds, let's just quickly put it on a daily chart for the yield. So let's have a look at the 1-year yield. You can see the 1-year yield, it's been going down and down and down. But if you look at the 2-year yield, it has been coming down a lot. But as you can see, just over the last few days, the yields just seem to have reached a little bit of a floor, as I was saying yesterday, at about 3.46, 3.47, something like that. But as you guys can see here, they're actually up quite a bit, sort of 7, 8, 9, 10 basis points have come back a little bit. So the market now probably trading in this range. I don't know that these can rip too much higher, as I was saying yesterday, because the chances of the Fed hiking, for example, are very minimal. But they could drift higher if, Powell doesn't signal today again, any sort of urgent need to cut or cut aggressively. And remember, what really got the market's attention last Wednesday at the FOMC meeting was when Powell said that the chances of a 50 basis point cuts were not really discussed seriously. So the market is a little bit nervous and thinking that any kind of hawkish or strong economic data, any strong sort of inflation numbers, and keep in mind we have the PCE coming out this Friday. That could potentially the two extra cuts that could be whittled away, and we get down to or maybe just one cut by the end of the year. So let's keep an eye on that. Also, I just want to keep on looking at the yield curve. It is interesting what's happening with the yield curve. As you can see, a tiny bit of sort of steepening recently, but overall we've had a little bit of flattening. And that's just because the market is concerned that maybe the Fed ultimately, like it should steepen if you believe that the economy will remain strong and that the inflation remains sticky, that should steepen a little bit. So, and that's what's been sort of happening here. But that also will be a function of what Powell says today. If Powell comes out in a fairly data-dependent way, that could actually flatten a little bit more as he takes potentially the heat out of more rate cuts coming. So let's keep an eye on the curve to get some sort of more perspective on that. What is interesting, just looking at gold, I'm going to put it on the spot gold here. Look at this. This is just ripping higher. We're up again. If we look at the futures, I mean, we're up another, basically $40 or so. And gold just continues to rip higher and higher. And you've got to say that at this point, there's $4,000. It looks as though, quite possibly we're going to be ripping higher. And again, we've got some other news overnight, essentially coming out of China. There's reports, there's a report on Bloomberg that China is interested in becoming a custodian of gold bullion, so the actual physical bars, for maybe sort of countries which are not, let's say, in the US Western kind of bloc. And so definitely this is kind of a symbolic thing. China really signaling not only to the US and let's say Western Europe, but also to the BRICS countries and its allies that it really wants to become a sort of a more globally dominant player in the gold bullion market. And at the end of the day, that signals sort of confidence in gold, the fact that China is very much interested in gold. China at an institutional level is very much looking at gold. And as you can see, gold ripping higher. If we look at silver, also silver ripping higher. It's now actually, this is interesting. I was showing you yesterday. If we look at this weekly chart going all the way back to, actually, let's even put it on a monthly, just make our life simpler. I think going all the way, look at this, going all the way back to 2011. So this is just a huge breakout in the precious metals. Again, this is a monthly chart. And look at this, we're going all the way back here to 2011, over $44. Now, of course, the dollar, so, the point is that could this push up to the late 40s, up to 48? Why not? I mean, because what's happening here is quite interesting. I saw a chart. Keep in this morning, but keep in mind, like if I actually show you something, I just want to quickly put something on which sort of explains maybe a little bit. If we do SPY and we divide it by GLD, let's go there. So remember that the SPY, when we talk about stocks, they are denominated in a currency, in dollars. We say, oh, so a certain stock is trading at $500, for example. But if we actually look here and look at the SPY, not denominated in dollars, but denominated in gold, you can see here on the daily chart, not such a strong performance. And if we actually put this back on a weekly chart or even a monthly chart, it is quite sobering just to look at this and say that that stocks denominated in what we could maybe consider a currency other than the US dollar, so not fiat currency. Just to put this in perspective, we are at a level which essentially is the same as 2013. So if we were just to look at the SPY chart, we go, oh my God, stocks are going up crazily and gold's going up. But the reality is really this is a story of purchasing power of the US dollar. So let's just keep that in mind. As I say, that's the SPY divided by GLD. You can see that ratio there, and it's as I say, this is indicating that it's really a question of the debasement and the losing of value of fiat currency, specifically the US dollar. Interesting one to keep in mind. So let's keep a lookout on gold and silver. What is interesting, just talking about the metals, just looking at the London price for metals here, you can see that copper is not really joining the party with the precious metals, and that's indicating that it's still a certain amount of caution about sort of the global growth, about the AI story, data centers in China. So interesting that copper, is doing okay, but it's certainly not sort of busting out, and is certainly not following the path of the precious metals. Something else which I want to have a look at, apart from my tea mug. Today we get the global PMI, so let's just go back and have a look. We have the US PMIs. Now the S&P global PMIs are not as important or market moving for the US compared to the ISM manufacturing, but nonetheless it's a good metric, and it's highly we can compare it. It's very comparable with the other global PMIs. And just looking at the other global PMIs, we've got some interesting data. Well, when I say data, it is a survey coming out of the Eurozone this morning. So first of all, France was fairly disappointing, and there was commentary from the PMI team, essentially saying that the political risks and political uncertainty is weighing on sentiment and investment. But if we look at France, you can see that the manufacturing PMI came in at 48.1, so lower than last time and lower than expectations. But also the services was down a tick as well, and the composite was down. So France, it looks as though it's sort of weakening a little bit. Germany was a mixed bag. Manufacturing was actually down again, so you see 48.5 compared to the prior, and also lower than expectations. On the other hand, the services in Germany was higher than expected. So Germany does, and this is something we've been seeing for a few months now, that Germany's service sector and actually all over Europe, the service sector does seem to be relatively solid. There's a lot of tourism and obviously and things like this. So the service sector is holding up quite well. It's the manufacturing sector in Europe, and specifically France, Germany, which does seem to be sort of coming under a little bit of pressure, and maybe some of those tariffs, China. And there's been a lot of talk in China about what are they calling it? Disinvolution. And it's this idea in China that there's been too much capacity, there's been ferocious sort of competition. It's pushing down prices internally in China, it's pushing down sort of inflation, becoming deflation. And therefore, Chinese manufacturers are dumping everything globally. They have this sort of extra capacity and surplus, and they're dumping all of this stuff globally. So it is kind of interesting, just looking at what's happening in China, that the government there is trying to disincentivize sort of that ferocious competition, and actually is trying, for example, with solar panels, it's establishing a cartel to try and sort of put a floor under prices. And the thing to keep in mind with China is that if you look at something like the US, 59, 60% of the GDP in the US is actually sort of consumer consumption, so people going out and spending stuff. But China, which has a less robust, shall we say, sort of security net, social security net, people's rate of saving in China is much, much higher than, let's say, the US. And there's only about 40% of Chinese GDP, which is actually consumer consumption. And so what the government seems to be trying to do over in China is actually to boost the percentage of consumer consumption. So basically trying to encourage people to buy more stuff. And that way that could put a floor under the disinvolution and the deflation, and try and get the prices up. And globally, one of the reasons I'm mentioning this, apart from the fact it's interesting in China, is this idea, if that happens, there may be less of a surplus of goods in China, so therefore less dumping of low-cost goods sort of globally, and a little bit less competition. So it's definitely quite interesting to be looking at the internals of China over there. Okay, so that's that. Let's also we have our Governor Macklem today of the Bank of Canada, and basically let's have a quick look at the USD CAD. The Canadian dollar is doing okay against the USD CAD, but this is really a function of probably US dollar sort of weakness in general. You see here US dollar pushing a little bit higher against the CAD, and probably just staying in this trade range. Basically about 136 to about 139. I think that seems to be the trade range, and because Canada really is, there's a lot of uncertainty around trade. It's been hit pretty hard by tariffs. Unemployment rate is going up. Sort of GDP is stagnating. So Canada has some structural problems. So it'll be interesting to see what Governor Macklem of the BOC says today, whether there's more rate cuts coming. We know they cut last week. Are there more rate cuts on the way? And just also to see how that plays out in terms of the Canadian dollar, and maybe not so much the loonie against the USD, but against some of the cross currencies. And you can see here that something like the Euro CAD, Euro pushing consistently higher. If we look at something like Aussie CAD, let's have a look at that. Generally, the Aussie's been fairly strong. It's come down a little bit, maybe pushing a little bit higher here. So some of these dollar commodities are actually outperforming a CAD in terms of that dollar block. So let's listen out for Governor Macklem today. And finally, that's it. So let's just also have a look at the stocks. We know we got a bit of a boost yesterday. There's going to be an investment apparently of $100 billion by NVIDIA into OpenAI, build out of data centers. But specifically, NVIDIA will providing some of their sort of high leverage sort of chips to OpenAI. So, more positive news in a certain sense for the tech sector. We see here the S&P 500 going higher, grinding a lot higher. We see Nasdaq grinding higher. We see the Russell also doing pretty well, enjoying the sort of the lower interest rates. So U.S. stocks are doing pretty well. Some people are pointing to things that we look at the equal weight and see that that's less dynamic, but still it is trading around highs. And we look at the Mag 7s doing very, very well, as you can see, just pushing higher and higher. And something which is kind of interesting, like a kind of a metric we can keep an eye on, is something like in the S&P 500. This is the equities above the 50-day average. And you can see that, that is a bit sort of flatlining here. So the number of equities, percentage of equities which are actually over the 50-day average is sort of flatlining. So again, important to realize that a lot of these gains in the stocks, they are being led by the usual suspects, the top sort of, 8, 9, 10 stocks. So let's see how let's keep an eye on breadth and see how far that can keep on grinding upwards. But as I say, technically, there's no damage done to the markets, to the chart at this point, and the US equities are doing very, very well. Okay, guys, I'll leave it there. Okay, we also have Trump today at the UN. There's a few stocks, the maker of Tylenol, probably under a little bit of pressure potentially, but I'm most interested to see what Jerome Powell has to say, and also Governor Macklem of the BOC, just to get a read on what could be a future direction of the Canadian dollar and interest rate cuts. Thanks very much, guys. Have a great day, and we shall be talking again tomorrow. Thank you.